And welcome. This is Mary Ellen McGonigal with your Friday afternoon MEM Edge show. And of course, this is the show where we bring you where the action is in the broader markets, and certainly a very funneled, focused price action last week. We'll get into that. So with the news last week, there were certainly some impactful items that took shape. First up was the fact that several federal governors, Federal Reserve governors, were speaking at various events, and their comments were rather mixed as it relates to monetary policy for the Federal Reserve. And we know at this time, as it has been for most of this year, interest rates are the primary driver of the broader markets. So we did see initially interest rates recede, but as these speaking engagements carried on, the news was not constructive, as many of these Fed governors feel that we do still have work to do before inflation recedes enough so that the interest rate hike campaign can be halted. That news was really brought home by comments from Fed Chair Powell on Thursday, where he reiterated that comment, and the markets pulled back rather sharply. Today's rally, of course, on Friday was a welcome relief. So we'll get into all of that today. Also, we did get news on Friday today that consumer sentiment fell for the fourth month in a row. And here we are again with really negative economic data being constructive for the markets. Now, next week, we have very critical data by way of inflation numbers. Core CPI and PPI data is due next week, so you want to be on alert for that. Now, from here, let's go ahead and take a look at those markets. And here we are. This is a daily price chart of the S&P 500. You can see last week, I talked about this last Friday, where the broader markets did close above this key 50-day simple moving average. And we have continued to advance beyond that, which is good news. We have a positive RSI and stochastics on this daily chart, which is confirming the uptrend that we are seeing in the broader markets. From here, I do want to share another view of the S&P 500 so that you can see the real impact that interest rates have had and are continuing to have. Back here, I'm highlighting that rally in the markets from May into the markets peak this year in late July. And you'll see for the most part, interest rates were really down below that 4% level. We did get up to about 4.2%, and that was just enough to have this market pulling back. This week, this is the yield on the 10-year, this thin black line, and we can see that we are lower, but we still remain elevated at 4.6%. So from here, let's go ahead and take a look at these sectors within the S&P 500. This is a 2-month daily price chart view. And I've added a relative strength indicator, sorted these sectors in descending order. Now, what we can see immediately is an uptick here in technology, and it was by far the leading sector for the week, up 4.5%. And we can also see that this particular sector is poised for a 4-month base breakout, very constructive. Now, beyond this move into technology, it is worth noting that a number of sectors ended in the red, and that is led by energy stocks, down 3.8% for the week. All about that price of oil. We'll take a look at that as we move through. Also, on the forefront here, as it relates to groups that ended in the red, healthcare down almost 1%. And you can see this move lower. There was news that a company, AstraZeneca, is going to be coming out with a rival weight loss drug. So Eli Lilly did take it on the chin, but other healthcare areas are also suffering. And we'll take a look at that medical products group. That was down 3%. So we are seeing also on that generally defensive side of things, utilities were down 2.5%, and then real estate stocks down 2%. So at the end of the day, it was very much funneled into the technology area, also communication services up 1.5%. a little bit more than the S&P 500. And from here, we're going to go ahead and take a look at those industry groups beyond these sectors. And I did want to share with you where that strength in technology is emanating from. So here I've used several ETFs, again, a 2-month daily price chart view, sorted by strength to weakness. And up here at the forefront, take a look. This is tech software ETF IGV, up 4%. A lot of this being driven by earnings. However, most impactful is that nice pullback in interest rates. Software stocks do tend to get the most impacted negatively when interest rates are on the rise because it reduces their future earnings. And so from here, we also want to take a look at another group, Semiconductors, up 4% today. And overall, it was up 4% for the week, but most of those gains coming in today, all about NVIDIA and some of the announced products. I'm going to be talking about that quite extensively in my weekly report that's going to come out on Sunday. Also from here, taking a look at some of these underlying sectors, it was not all green. Let's take a look here at the retail XRT ETF, down 3.5%. Another sector or sub-industry grouping that we can take a look at is that pricing on Brent crude oil. And take a look, a steep deterioration here, down at 80 from a peak in price only several weeks ago up here at the 94 level. So that really hurt the energy group. We talked about that group being down 3.8%. And another area that really suffered this week is small caps. IWM is the Russell 2000 ETF, and we can see it really pulled back down 3.1%. Now, at the end of the day, really what I'm highlighting is the fact that we did see a nice rally in the NASDAQ, up 2.4, the S&P. However, of note is the fact that it was very focused as far as those areas that did outperform. While it is constructive, certainly for those outperforming areas, we will want to see a broadening out of the market. So today's show is going to be abbreviated, but I did not want to end without sharing with you a view of the equal weighted S&P 500. Now, the relevance here is as the broader markets continue potentially with this uptrend, we will want to see the equal weighted S&P participate with that. And this is because we need to see a broadening out of the markets in order to experience a sustained rally. We need only look at this June into August period when areas outside of the Magnificent Seven and those focused mega cap names helped propel the broader markets higher. So we are going to see a little bit more by way of participation before we can see a nice sustained rally. I'm going to leave it there. Everyone have a fantastic weekend, and I will look for you here again next Friday.